So, for today, let's talk about the financial market. So, one of the decision na kasama sa financial management is kung paano ba tayo mag-acquire ng funds. So, example nito ay halimbawa kung tayo ay mag-open ng isang small business. So, paano ba tayo magre-raise ng kapital na required doon sa ating bubuksang negosyo? Tayo ba ay manghihiram ng pera o gagamitin natin yung mismong savings natin? So, in the government naman, sa parte naman ng gobyerno, kung halimbawa at tatayo sila ng mga infrastructure like bridges or kaya a public hospital, ah, pero yung tax collection naman nila para makabuo o para pondohan yung mga infrastrukturang itatayo ay insufficient. So, paano ba tayo makakakuha ng additional funding? O how about if we are on the other side with the one who has excess funds? Tayo ba ay magpapahiram sa ibang tao, sa negosyo, o kaya naman sa gobyerno kapalit ng revenue natin? What options do you have? And what are the risks involved? So these questions are just some of the concern when we talk about financial markets. So in this lesson, you will learn about the functions of financial markets, their types, and their role in the financial system. So first, it is important to differentiate the ordinary markets to the financial markets. So halimbawa na lang, if we want to cook our favorite dish, definitely we need to go to market to buy some ingredients. So when we say market, these are the place kung saan nagtatagpo si seller at saka si buyer. Si seller sa market ay inai-offer nila yung kanilang produkto at si buyer naman ay may kakayahan o may kalayaan pumili ng kanilang bibilihin. So most of the time, you will buy ingredient from your regular suppliers o yung tinatawag natin na suking tindahan. It's really because you are already trust the quality of their products. So same with the financial markets. Ano po? It is similar to these ordinary markets. It is also a space where the seller and the buyer meet to satisfy their needs, wants, and also demands. But instead of trading manufactured goods and products such as the ingredient of your favorite dish, the financial market offers the product and resources. In short, the financial market is where you go if you want to trade the money or capital with others. In the Philippines, uh, the well-known financial market is what we call the Philippine Stock Exchange. So, through financial markets, companies could acquire funds and they need to finance their activities, programs, and also the expansions. These companies go to the financial market to borrow money from investor and lenders. On the other hand, investor lend monies to firms and governments by purchasing financial asset and expect that its value would grow in the future. So para makita natin ng mas madali, let's have an illustration. Say for example, an investor bought 100 shares from the company at ang initial value ng bawat share is 1 peso. So the investor definitely will pay the 100 pesos para siya ay makakuha ng 100 shares sa company. Pagpalagay natin within 3 years, the company consistently grow its business and increase the value of its asset, thus raising the price of per share to 5 pesos. So in short, after 3 years, the investor who holds 100 shares would now have 500 pesos. When we talk about financial management, we learn that it involves the acquisition, proper allocation, and efficient management of money to maximize one's wealth. It concerns individual, governments, and also businesses. Sound financial management requires a good understanding of financial system. This consists of financial institution, financial markets, and financial instrument. They interact with each other to facilitate the flow of funds and financial capital between the savers and also the borrowers. When we talk about financial system, it facilitates trading of funds through financial instrument and product. It is a complex network of financial institution and markets. Financial institutions serve as intermediaries between creditors and lenders, and also debtors or borrowers. Meanwhile, financial markets provide the trading floor through which finance-related transaction occurs. Financial market is a component in the financial system that aids in the efficient transfer of funds from lenders to borrowers so that those who have investment opportunities can utilize it to their most profitable and productive uses. In other words, financial market is a place where individuals and entities who have excess funds buy financial products to help those who need available funds like sellers or borrowers. In return for buying these products, investors expect that they would receive revenues through interest or what we call dividends. Financial markets are important to companies as they deal with different financial decisions such as maintaining cash reserve to ensure smooth day-to-day operation while funding expansion activities that would increase their wealth in the future. For instance, a manufacturing company might want to upgrade its machine to increase its productivity and profit. However, since these machines are too expensive, the company could not use all available funds to purchase them. Otherwise, the remaining cash on hands may not be sufficient for wages, materials, or other operating expenses. Financial market helps companies acquire money and capital from other sources. So for us to be able to help to distinguish financial market from financial institution and from financial instrument. So when we talk about financial markets, it refers to the platforms for sufficient allocation. When we talk about financial markets, it refers to the platforms for efficient allocations of funds and lenders to borrowers or sellers to buyers. The main role of financial markets in financial system is it provides financial instrument can be traded. The example of this is the Philippine Stock Exchange. While financial institution is the financial intermediaries between those who need funds and those who have excess funds. So the main role of financial institution in financial system is it serve as primary intermediaries between the buyers and the sellers of financial instrument. The example of these are the stock brokerage firms and mutual funds companies. When we talk about financial instruments, it is the financial assets or securities which hold monetary value and can be traded in the market. The main role of financial instrument in the financial system is it serves as means of payment and could be traded to increase the wealth of an individual. The example of this is the stock and also the bonds. So let's talk about the types of financial markets. The financial market is the space where the money and capital is traded, one of the sources to another. Thus, there are two types of financial market. The first one is the money market and the second one is the capital market. So when we say money market, it caters lenders and borrowers who have short-term financial needs. The asset which are sold and bought in this market can be easily convertible into cash, and their maturity typically ranges from 1 day to 1 year. Therefore, the money market is a good platform for individuals and entities who seek liquidity. So when we talk about liquidity, liquidity refers to the ease of converting an asset into cash. Short-term securities are traded in financial market. Example of short-term security are deposits, treasury bills, and interbank loans, which are considered highly liquid financial products. These short-term security traded in this type of financial market are also known as money market instruments. Individuals use the money market to invest their money in a safe and low-risk place. For instance, depositors lend their money through bank deposit and expect it to gain interest in a year. Meanwhile, entities such as banks place their funds in the money markets to maintain their liquidity levels. Treasury bills issued by the government considered as the safest among the money market instruments to place short-term saving or investments. However, its rate of return is lower compared to the financial instruments. Type of financial market is the capital market. So capital market is a platform for buying and selling long-term securities. When we say long-term securities, securities that matured in more than 1 year. Example of long-term securities are stocks, which are traded in stocks market, and bonds, which are traded in bond market. Stocks, or what we call shares, are representation of ownership to a portion of a corporation. Investor who buy stocks accept to receive residual claims from the company through dividends. Stocks are therefore considered as equity securities, and stocks markets are also known as equity markets. So when we say bonds, these are the security issued by the companies and government corporation that seek additional capital to fund the expansion of project and also other operation. Investor buy bonds in the forms of obligations, which why these are also known as the debt securities. Unlike investors who buy stocks, bonds holders are considered creditors and not owners of the corporation. The capital market is considered the largest and the most complex type of market because it comprises various sub-markets such as stock market, bond markets, foreign exchange market, spot market, and also others. Capital markets are further categorized into two types, the primary and the secondary market. The long-term security are created in the market are called primary market. Corporation typically sell stocks to raise their capital and finance their business operations and also activities. Individuals and entities buy stocks to gain ownership to a portion of the corporation, and they expect to gain profit from dividends and capital gains. When a corporation issued and sells securities to the public for the first time, it is called the initial public offerings, or what we call the IPO. The proceed from the IPO goes directly to the issuer of the security, which in this case is the corporation. The securities are still available after the IPO. These securities are made available to buyers, investors, and traders in the secondary market. The secondary market is the market where the investor can buy more security or sell initial securities. This time, the proceed will go to the current owner of the securities. An example of secondary market is the stock exchange, a marketplace where the stock are publicly listed, companies are acquired and sold. So in the Philippines, the Philippine Stock Exchange, or the PSE, is the existing stock exchange in the country. An example of how corporation stocks are traded in the primary and secondary markets. So let's discuss the function of financial markets. The primary function of the financial market is allowing the smooth flow of capital asset from various sources. The role of financial markets in the financial system is crucial that when it is removed from the system, the whole economy would collapse. So let's show the seven function of financial markets. We have the price determination, we have funds mobilization, liquidity, risk sharing, easy access, reduction in transaction costs, and capital formation. The first function is the price determination. Like any other marketplace, the demand and supplies for financial capital determine the prices of asset and the rates of return. In financial market, the borrowers are the one that demand assets, while the suppliers are the savers or what we call investors. The next one is the fund mobilization. Financial market helps in the efficient allocation of funds toward product investment. Firms with surplus capital can generate revenue by looking at the offerings of the financial market. The third one is the liquidity. Financial market allows sellers to trade their asset and convert them into cash. The term liquidity refers to the ease of converting an asset to cash. Risk sharing. Financial markets allow a group of people to transfer or share the risk of potential gains or losses. Buying insurance policies is known from risk sharing. Easy access. Financial markets made the trading of security accessible for both buyer and sellers. The financial markets informs the investor of all the offered financial asset and their rates of return, and let borrowers easily present the public their offerings. Reduction of transaction cost. Financial markets lessen the unnecessary costs related to the acquisition and also disposal of securities. The pieces of information made available by the markets enhance the knowledge and ability of individuals and firms involved. Capital formation. Financial markets provides the various ways to increase the capital of an enterprise and the net investment of a nation. So the importance of financial market is it increase the productivity and efficiency of the economy in the financial system. Through the financial markets, individuals, companies, and also government can raise capital by participating in various financial markets. Investment can help meet the short-term and long-term financial needs of individual households, while companies can also increase their production level when they can raise their capital. On the other hand, government can create more projects, thus creating job opportunities for their constituent as well. Whether these units invest in money markets or capital markets, the flow of funds from these who have excess and those who are in need are balanced in the financial system through the financial market. So just keep in mind that when we talk about financial market, it is the market where the buyer and seller or lender and borrowers gather to trade financial securities. It facilitates the flow of funds from those excess funds and those with sufficient funds. There are two types of financial markets. We have money market and the capital market. Short-term security are sold and bought in the money market while the long-term securities are traded in capital market. The role of financial market is to provide a platform for financial instrument to be traded. Financial institution aid the financial market by serving intermediaries between buyer and sellers of those financial instruments. Financial markets are important to efficient allocate financial resources from those who have a surplus of funds to those who need funds. Through investment, individual, businesses, and government are given the opportunity to raise their capital for their operation.